financial statement series at the Peterson Institute for International Economics. I'm Nicolas Véron. It's my great pleasure today to host Andrea, Enria, and Tamim Bayoumi for this discussion of European banking supervision. 6 years on November 4, 2014, the European Central Bank took over banking supervision from national authorities for all the banks in the Eurozone, in the Euro area. We'll have the details in a minute from Andrea. And I should also note that today, November 9, is the birthday of Jean Monnet, the father, the intellectual father of European integration. That's by a strange coincidence. It's exactly 6 months after or before the anniversary of Robert Schuman, who was the other father of European integration, and whose anniversary May 9 is not anniversary, sorry, the Declaration of Paris on May 9, 1950, which is the Day of Europe in the European Union. Anyway, I want to thank all the other Peterson Institute colleagues who help organize this series, Lily Day, who is with us, and the whole teams and events meeting at the Peterson Institute, led by Ivan Priestley, and also the communications team, Helen Hillebrand, Steve Weissman, and others who make this the series that it is. And let me briefly introduce our speakers. Andrea Enria is, of course, chair of the Supervisory Board of the European Central Bank. So he's in the context of the European Central Bank, the most senior official who deals with European banking supervision. And he will maybe explain us how that interacts with the other functions of the bank. He studied economics at Bocconi University in Milan, at the University of Cambridge in the UK. He worked at the Bank of Italy for a long time. He joined it in 1988, which by coincidence is the same year as Tam Bayoumi joined the IMF. So there is a nice Plutarchian parallelism here. In 1995, he was advisor to President Lamberto Dini of Italy. In 1999, when the Euro started, he joined the European Central Bank and worked on banking supervision issues there for 5 years until 2004. He then was Secretary General of the newly created Committee of European Banking Supervisors, which later morphed into the European Banking Authority, the EBA, for 4 years until 2008. Then from 2008 to 2010, he went back to the Bank of Italy, was head of banking supervision there under Mario Draghi as governor, then went back to not SEPS, but the European Banking Authorities that replaced it. And 1st January 2011 was the chair of the EBA in London and Paris from 2011 to 2018. And on the 1st of January of 2019, replaced Daniel Nouy, who had been the first chair of the European Central Bank Supervisory Board, in his current position. It's not just that he has this incredibly rich career on banking and supervisory issues, it's also that Andrea Enria has, over the years, expressed a lot of leadership on the substantial issues, on calling for banks to shore up their capital positions, and also now that he's supervisor in terms of supervisory decisions. As an external observer, of course, I cannot watch the individual decisions bank by bank, but I see the policy decisions that apply to the sector, for example, the capital relief and ban on dividends that was announced at the beginning of the COVID-19 crisis. And I think this has been recognized internationally as a show of leadership for this newly established framework of supervision at the ECB. Tam Bayoumi studied also at the University of Cambridge and went for a PhD at Stanford. He's been, as I said, at the IMF since 1988 and retired this year. So we know him a lot at the Peterson Institute because he was a visiting fellow for 1 year from November 2015 to October 2016, and actually in the office next to mine. So we had many conversations during that time. And from that period came a book, Unfinished Business, the Unexplored Causes of the Financial Crisis and the Lessons Yet to be Learned, which was published in 2017 and goes really into an in-depth exploration of not just the macro causes or the supervisory causes, but frames them in a kind of macro financial thinking, which I have found very useful to think about the great financial crisis. At the IMF, Tam has dealt with such a broad range of issues that I cannot try to summarize them, but lots of issues about surveillance, risk analysis, monetary policy, and macro-financial thinking, which I think is very relevant for our discussion today. So with this said, Andrea, over to you.
Thank you very much, Nicolas, for inviting me and for organizing this sort of anniversary event for ECB banking supervision. As you said, 6 years since the start, really, in practice of the banking union, which has been indeed a momentous event, a major change, as you kindly mentioned in your introductory remarks. Let's say I've been dealing with European supervisory issues for a while, and I knew, I've known for a long while how difficult let's say, the move to European supervision has been. And the decision came after, you know, the biggest shock for the European banking sector, in a moment in which there was still a lot of legacy issues to deal with. So I would say that the main challenge was to start by, sorry, I'm trying to upload my presentation. Let's see if I manage to do that. Okay, it came very nicely when I was trying.
As usual, the demo was easy.
Yeah. Okay. Anyway, let me go forward. The main issues that we had to grapple with were, of course, the beefing up of the capital position of European banks on the one hand, and the effort also to clean the balance sheet of the European banks after the twin crisis, the financial crisis and the sovereign debt crisis. And the banking union was also established as a way to cut the link between the banks and their own sovereign, which was, of course, another important element of instability that was very visible during the crisis.
Andrea, sorry to interrupt, but I have your slides. Should I put them on screen and you tell me when to go from one to the other?
That would be very, very helpful. Thank you very much. Sorry for that. So I was saying that the two main issues were beefing up the capital position, clean the bank's balance sheet, and the third one was to deal with the problems that had been encountered in terms of using internal models that proved not effective enough during the financial crisis, and make them more reliable and consistent across banks. So this slide shows the path from 2014, when the ECB was attributed supervisory tasks, up to 2019, but the increase continued in 2020. The capital position kept being strengthened. There has been a significant decline in the level of non-performing loans throughout the years. If you can move to the next slide, Nicolas, please. We have run this summer a sort of vulnerability analysis to check how resilient the banking sector would be in different scenarios during the current COVID-19 shock. And to some extent, it shows our analysis showed that if we remained on the central scenario of a very harsh recession, actually the harshest recession on record in 2020, with a rebound in the following 2 years to the pre-crisis level, the banking sector seemed to be resilient enough to shelter this shock. Of course, things would be getting a little bit more difficult if we are going to a double dip this year. The next slide shows.
So yeah. CET1 is Common Equity Tier 1 capital ratio,
this is the
right?
capital. Yeah, this is the Common Equity ratio. So the main yardstick that we use to assess the resilience of the European banks.
And of course, BU is a banking union. What does TR stand for?
This is the transitional ratio is not particularly relevant. It's the fact that we use both the fully loaded and the transition.
Okay.
Yeah, exactly. The non-fully loaded now is mainly for the let's say the new accounting standards which are being phased in right now.
Right.
In the next slide, we show let's say the way in which we are getting grip of the asset quality, so the non-performing loans, the NPLs, and you see that for each bank we set a sort of target with clear targets in terms of all the inflows, all the outflows, and so far the process is progressing according to schedule, and many banks are even overachieving with respect to the targets. The next slide shows the efforts we have done on.
To understand this, this is
this is referred to
okay. So this is one year of NPL reduction and how it happens.
Exactly,
right?
Exactly. This is where we start. At the end, you have the targets in yellow that we set, which are then, of course, broken down on a bank-by-bank basis. And in the middle, you have all the inflows in NPLs, the outflows in NPLs. We set target for each individual bucket, and we follow the banks closely in terms of how they execute their let's say their plans in terms of
a cure means that basically the bad loan becomes a good loan, right? You revise that.
Yeah, exactly.
Okay.
That's our bad loans, which are either you're restructured or start paying again. Yes.
Okay, thank you.
And they're of course cured also only after a certain time in which they start paying back. Not on one payment is not enough, of course.
Sorry for interrupting.
No, please. So this is just to put, let's say, on record the third area of improvement, which is the fact that, internal models didn't perform that well during the crisis. So there was a massive effort to restore the reliability of internal models. On the ECB side, we completed last year a very resource-intensive set of on-site investigations on internal models, which led to a number of decisions, requests to change the models, and in many cases also material capital impact for each bank. So moving forward and to relatively more recent achievements or work in progress, let's say. So when I joined last year, let's say there was I would say a decent reputation of the ECB supervision in terms of demanding conservative supervision, but there was a little bit of concern for ECB sometimes surprising markets and not being that predictable in terms of its own methodologies and approaches. So we pursued a policy also of becoming more understandable. For instance, I quote here at the bottom of the chart of the slide a publication that we recently made on our approach to bank consolidation. When I started, I received feedback from many banks and investors, analysts, saying that basically the major impediment to the necessary consolidation in the sector was perceived to be actually ECB supervision. So we try to clarify our approach to supervision and to take this misunderstanding off the table, let's say. And there are other areas in which we have tried to be more transparent, publishing our requirements on a bank-by-bank basis on our websites, and clarifying our methodologies and approaches. So the next slide shows, as you referred to.
This is not just because I think of myself as acronym police, but I think it's actually substantially interesting if you can explain P2R, SI, and SREP for our audience.
Yes, P2R are the Pillar 2 requirements, so the requirements that the supervisors set on a bank-by-bank basis on top of the minimum regulatory requirements. So these are reflecting the specific idiosyncratic risks of each bank. The SIs are the significant institutions, so the institutions which are directly under the supervision of the ECB, where there are in the euro area, what we call less significant institutions, which are smaller banks more generally, or less systemically important banks, which are under the still under the responsibility of the ECB, but the day-to-day supervision is actually run by the national authorities.
And SREP?
The SREP methodology is the methodology that we use for the Pillar 2, for setting up exactly these requirements on a bank by bank basis. Sorry for the acronyms.
And SREP is a supervisory
review and evaluation process. Yes.
Thank you very much.
It's a process that we do every year to set not only the capital requirements, but also liquidity requirements and more general setting some sort of recommendations on the banks on how to improve their risk management, their governance, and the like. In this slide, I try to, let's say, put on the table also what I consider also an important achievement. You refer to it, Nicolas. This time I was, as you mentioned, in the SEBS, the Committee of European Banking Supervisors, after shortly before Lehman, and it's clear that at the time the response was entirely national, not coordinated, and that left, I would say, a lot of, let's say, difficult legacies for the European banking sector. This time, the banking union, the ECB supervision managed to, to provide a fast and unified supervisory response. And this was the first time. It's interesting, nobody noticed that, but that we also issued our first, let's say, package of measures on the same day as the ECB, our colleagues on the monetary policy side, issued their own, let's say, initiatives and policy accommodation. And according also to analysis done by our economists, there have been a very important positive interaction between these two sets of measures in preventing a significant tightening of credit standards immediately after the hit from the pandemic. And we took a number of measures. I mean, again, also here, I'm sure there will be other acronyms that have not yet clarified, but all in all, I would just flag the fact that we tried to create some sort of capital space to use the buffers that were supposed to be used in crisis time by banks to give operational flexibility to deal with the move to remote working for most of the banks, and also to preserve capital within the system to absorb losses and to lend to households, small businesses, and households, rather than remunerate shareholders via dividend payments or buybacks. So moving forward to my last, let's say, slide, let's say, what are the priorities for the future? Well, there are many, of course, but I would focus your attention on three main areas. I mean, the first one, of course, is the continued response to the COVID-19 crisis. We are now at a juncture in which we are trying to put pressure on banks to focus their credit risk management and to recognize as early as possible asset quality deterioration and take action to manage it actively. Sometimes there is this misperception that by being proactive and recognizing, let's say, deterioration in asset quality, you are being procyclical. Actually, it's quite the opposite. The later you recognize the losses and the later you take steps to restructure loans, and the larger the hit at the end of the day. And I think that in this case, especially with the moratoria and other public initiatives that preclude visibility on the payments by the customers, this aspect is particularly important. We are also trying, and this already started, to set up forward guidance on how the buffers, which are now banks are now enabled to use, will be reestablished once the shock is over, so that there is clear understanding by everybody on how this use and rebuild of buffers would work in practice, with some flexibility, but also with some clarity that, of course, this is not a deregulatory move, but just a temporary alleviation of the requirements. And also, we are also preparing for the tail risk of a severe shock, so much more severe of what is now the central scenario in terms of asset quality and hit on capital. As I mentioned before in our vulnerability analysis, in a severe but still plausible scenario, we would have a build-up of non-performing loans on the scale of 1.4 trillion, so well above even the legacy of the last crisis, and the hit to capital would be significant. And that's why I also recently put forward the proposal to start working or preparing already, although we hope not to need it, to address these type of issues, for instance, via asset management companies that could help cleaning fast the balance sheet of the banks. The second bucket of priorities is to address the weak profitability and the structural inefficiency of the European banking sector. There is still a lot of excess capacity in the sector. We have not been effective enough after the last crisis to, to reorganize the sector, to let capacity going out of the banks, of the banking industry. We didn't have enough consolidation, as was, for instance, the case in the US, and this means that some banks do not have a sustainable business model right now. So focusing from the supervisory perspective, efforts to strengthen the business model, to include robust governance, appropriate investments in IT, and to accompany well-designed and sustainable consolidation, which was the point I was mentioning before, as a way to move to a more structurally, let's say, resilient sector going forward. And finally, an area which is not entirely under our remit, actually is only marginally under our remit, which is the finalization of the banking union, of course. We are still lacking the third pillar of the banking union, the deposit guarantee scheme. So we have all the controls and also the resolution of banks under responsibility of EU agencies, so the ECB for supervision and the Single Resolution Board for resolution, but the deposit guarantee scheme remains at the moment national. And this, to some extent, is preventing a full integration of the banking sector. So there has been a lot of ring fencing as a legacy of the last crisis. In the euro area, the sector remains heavily segmented in national buckets. And let's say, without this final step, let's say that this remains an element of fragility, in my view, for the sector as a whole. Not only an issue of profitability, it's also an issue of fragility when a shock hits. So we don't have the sort of private risk sharing that, for instance, we have seen at work in the US during the last crisis. So we're also trying, from the supervisory perspective, under the current regulatory framework, and notwithstanding it is suboptimal, to incentivize a little bit mechanisms to facilitate the integration in the management of capital and liquidity at the group-wide level within the banking union, for instance, by activating intra-group support guarantees within groups that would provide sufficient reassurance. And I will leave it here. Thank you, Nicolas.
Thank you very much, Andrea, and apologies for my numerous interruptions. Over to you, Tam.
Well, thank you, Nicolas. It's great to be back here in the PIIE community, where I spent a very, very happy year writing the book which Nicolas mentioned, Unfinished Business, which discussed the deep origins of the 2008 financial crisis, and which I regard as both a US and a European banking crisis. And that was one of the points of the book. So given this long-term perspective that I had then, I'd like to take a step back and look at the single supervisory mechanism from a fairly broad perspective. Obviously, the trick with both the single currency and the single market is to add federated systems on top of existing splintered national systems. And bank regulation and supervision are obviously a good example of this. So the Maastricht Treaty solution was to leave regulation and supervision to individual countries, and that blew up spectacularly in 2008. The reason for this was regulatory competition across the national supervisors, combined with the Basel Committee's mistake of letting large banks use their own internal risk models to create their own capital buffers. And this led to excessively large and excessively leveraged banks in Europe. Now, after the crisis, the model was changed. Large banks are now, as was discussed, are supervised by the ECB. Actually, all banks are, but in practice, the smaller banks are supervised by the national authorities. Hence, the single supervisory mechanism that we're discussing today. Now, this is, of course, a big improvement of the earlier system. and the SSM has worked very diligently. But, you know, the entire system remains a work in progress. And so let's start with the basics. A good supervisory system, excuse me, should be independent, well-resourced, and apply rules consistently. US FDIC is obviously a good example of this. The SSM is clearly legally independent, and that's a great step forward. On resources, it was noted in the IMF's 2018 Financial Sector Assessment report on the Euro area. The SSM is quite dependent on national country secondees from the national banks. And as such, you know, there's a tendency to have two masters, if you like, and that this was an issue in terms of there being competing demands for the resources. So that is something which still needs to be worried about. Now, on consistency, the attempt to add a consistent system on top of individual national systems with different laws and different banking systems was always going to be difficult. And the most obvious case is the one that Andrea mentioned, which is the lack of a complete banking union, including a common backstop and deposit insurance. But similar tensions can also be seen in supervision and resolution, including that large and small banks have different supervisors. Andrea discussed the classification of loans, including NPLs. And here, the interests of the national supervisors and the SSM may not always align. And that can be an issue. So, for example, take one of the things which Andrea talked about. It is true that NPL ratios have come down quite impressively over the last 5 years, by slightly over half. But if you look at the same period after the 2008 crisis in the US over 5 years, they actually came down to a third of what they were originally. So, you know, progress has been made and it is important, but, you know, other people made more progress with a more integrated system, which had less complications, shall we say. And at least in Italy, which is the country which I know best, and I realize that Andrea probably knows it a lot better than I do, but nevertheless, a lot of the NPLs were sold to third parties to sort out. And that is known to be a fairly expensive way of getting rid of non-performing loans compared to internal workouts, which is the preferred way of doing this. If you turn to bank resolution, state aid rules still give countries incentives to work out banks on their own rather than allowing the European-wide system to work. And that was seen a couple of years ago with a couple of Italian banks, where they were resolved under Italian rules, and as a result, the creditors got a rather better deal than you would have expected going into the process. I do want to come to the abuse of internal risk models, which, as I say, I think was fundamental to the 2008 crisis, including the broad banking crisis in the Euro area. Now here, a couple of things to note. The first is the European regulators opposed the eminently sensible US rule with a suggestion, which was to simply say, calculate based on the standard model, which all banks have to use, and calculate based on your own internal models and take whichever is larger. Now, why does that matter? It matters for two reasons. The first is you have lower capital for your large banks, but the second is it brings an bias towards larger banks. And that is one of the problems in the European system, which is there's too many large banks. There's an overbanked system with too many large banks. And that brings us to the final point, which Andrea made well, but is still an issue, which is there are too many banks. Europe is overbanked. And very little progress has been made in practice about reducing this in the way that it has been in the US. And consolidation and reduction of the size of the system. And if you have an overbanked system with low profitability, you're always going to be at risk of shocks creating problems. It's simply inevitable if you basically don't have companies which are making money. So all of these issues will become ever more pressing as the effects of COVID become clear, and in particular as the inevitable wave of bankruptcies that will follow it really start hitting the system. And so I wish Andrea very much luck, but I think that the real test of the SSM is still coming. Thank you, Nicolas.
Thanks very much, Tams. That was great. And I'd like to, before, we already have a number of questions, so there's no lack of engagement here, and I'll take them as much as I can. But I would like to first start with Tam's point on internal models, because that's also very much at the center of his analysis of the crisis. So Andrea, if you could tell us a bit more about the lessons learned and how you look at internal models of banks, and the one acronym that we left unexplained in your presentation, which was RWA, risk-weighted assets. How is that playing out going forward?
Well, thank you, Tam, for your comments, and Nicolas for the question. On internal models, I must say that usually the choice of the Basel Committee to open to internal model is presented as a sort of, liberalization and, let's say, culture of deregulation that was prevailing in the 90s and early 2000s. I must say that at the time, it was actually a recognition of weakness from the regulatory side. So the point that, to some extent, the approach that was based on the standardized approach, let's say the Basel I, was not proving effective because banks were very good in terms of shuffling risks off balance sheets and circumventing the requirements. So the idea, which was with hindsight definitely naive, that if you were able to align the internal risk management and measurement of banks with the internal requirements, was a recognition to some extent of weakness, but also let's say also the hope that you could have a better reflection of the risks in the regulatory framework. The reality has been very different from what was hoped for at the time, and we have done a lot of efforts to repair the process, but it is still indeed a big challenge. A few notice, but we published a paper in June on credit underwriting standards of banks, which showed, for instance, that banks are not using in their pricing of loans even their own expectation of losses according to their own internal models, and that actually the banks using internal models are much less good in terms of factoring their internal loss, their expected losses in the pricing than the banks using the standardized approach. So it means that we still have some way to go on internal models, I must say.
So on the whole question of non-performing loans, which obviously is currently very prominent, I have a provocative question from Alexander Benkwitz, who asked, why are there a problem to start with? Why is it important to get rid of NPLs? Is that operational concerns because the bank management is too busy with NPL-related work, or is it risk concerns? Like executing a stop-loss limit in case the NPL portfolio deteriorates further. Can you give us, and that's connected, of course, with your advocacy of an asset management company, can you give us a sense of your thinking here, and also maybe answer to Tam's point that selling NPLs is inefficient, which I guess is not universally shared as a point of argument, but that selling NPLs is inefficient compared to working out internally?
Well, thanks. This is a very important question to me. I mean, I think that The reality is that I've seen during the last crisis, banks struggling with very large amounts of non-performing loans. And it is very clear that the banks which has very high NPL ratios is a dysfunctional bank, basically. So first of all, many of these banks are not specialized in managing distressed assets. So they don't have the skills in-house. In general, very few people became CEO of the bank because they have been good at managing distressed assets. So you don't have, at least traditionally, you didn't have the brightest minds in your house in dealing with distressed assets, which meant that the banks were not good at doing it. Once you have a lot of NPLs, this absorbs a lot of your capital, so you have less capital room to make new loans, and basically you are deploying resources, capital, liquidity to assist customers that are not paying and not likely to paying you back in any foreseeable future, and you're unable basically to serve customers that would have profitable investment opportunities. So it's the whole sector, especially when the amount of NPLs become rather large, that becomes, let's say, dysfunctional. And in general, you need to see also the two sides. No, having a banking sector which is overloaded with NPLs means having, in general, small and medium enterprises, corporates, which are in that overhang. So which means that they are all focusing on rebuilding equity, on paying back their loans, rather than on investing and developing their business. So that's the moment when you need somebody that is able to restructure the loan and effectively, let's say, put the borrowers once again on a path to viability. And some banks have been better at doing that, especially those which have created internal NPL management vehicles. Some other banks have been dismally bad at doing that. In those cases, in my view, selling the NPLs and taking the upfront the capital hit might be, let's say, painful in terms of the price cut that you have to take at the moment of the sale, but still from a systemic point of view could be an improvement.
I'd like to, so that also, I guess, answered some of the points about the asset management company proposal, right? We have a question from Pierre Benet about more details about that. Can you give us a sense of the feedback you've received? Because you've made this advocacy very prominently a week or two ago in the Financial Times. So have you been surprised by the reactions in the public space?
No, I've not. I knew that at the moment there is nobody in Europe that wants to talk about, potential difficulties ahead of the banking sector. There is a narrative which is quite widespread that the banking sector is more resilient, which is true, by the way, and that nobody wants to hear about problems down the line. So everybody's pushing away this issue. But I think it is exactly the right moment to start discussing about these issues. I mean, again, I hope we don't get there. I hope that let's say most observers, banks themselves are right, and that indeed there is sufficient capital space now in the banking sector to deal with a spike in credit risk, and that actually, as some bankers argue, the peak has already been reached. But I think that as a supervisor, we should push the banks to think also about scenarios which are a little bit less rosy than this one. And we should start also as authorities to prepare to deal with scenarios which are harsher than this one. And the proposal I floated on the asset management company is exactly to alert both banks and public authorities that it might not be as smooth as many tend to expect right now.
I'll give the floor to Tam on this, but before I do that, let me poke you a bit further. you're the best informed person in the entire world about the situation of Eurozone banks. You have supervisory information that other people don't have, and you have analytical tools. So when you intervene in the public debate, of course, it sends a signal. How should we understand it? Are you telling the market, look, the situation is not as good as the conventional narrative has it, as you hinted at just before, or is it purely a kind of, foresight move saying, we don't know anything, but if things go wrong, we need to be prepared? Can you elaborate a bit on this?
No, it is the latter. I was discussing with a colleague in a supervisory authority a couple of days ago, and I think that the sentence that came out, that in my view reflects very well the current situation, is that all looks, let's say, clear and sunny if you look in the rear view mirror, and very foggy if you look in the windshield. No, so I think it is really an issue of uncertainty going forward. I think that we have to be humble enough to admit that we don't know what is going to happen. I mean, we know that
even the non-public supervisory information you have doesn't lift the fog.
I mean, look, I think that the financial crisis did justice of macroeconomic modeling. The recent US elections gave some justice, of course, to the polling models. I think that we should be humble. I mean, in a situation like this, in which we have an unprecedented shock, the reality is that we can guess what could happen, but let's say we don't have enough visibility. We have moratoria, payments stopped for a number of counterparts. We don't see a lot in terms of path towards, let's say, a future deterioration of asset quality. We have made some, let's say, the best estimates we could make in the vulnerability analysis that we published in July, and we said clearly that if we are on a central scenario, which at the moment is still our highest probability scenario, the European banking sector would have a capital hit around 190 basis points, which is manageable, would have a deterioration in asset quality, which could be managed with the ordinary tools that we have put in place after the last crisis. If we go instead into a more severe scenario, which is much less likely at the moment, but still not implausible, well, then we would have a significant surge in non-performing loans and a higher capital hit on the bank. So the point for me is, although this, let's say, this scenario has lower probability, I think we need to prepare for that as well. And there is no specific, let's say, additional knowledge that we have on the current situation. It's only an issue of the projections going forward.
Tam?
Look, I think Andrea hit the nail on the head in one way, in terms of the fact that, you know, it's very, very uncertain how the economic situation will move forward. I think there's always been this sort of hope that somehow we'll all wave a magic wand and we'll go back to how things were. I think the chance of that happening look ever more remote, frankly. And it always struck me as elements of a fantasy about it. The question is, you know, if the virus carries on mutating and it's difficult to get a vaccine and all of that kind of stuff, then what happens over the very long run to the airlines? What happens to services? What personal services? And in that case, you could end up with a very big hit and a very big restructuring of the entire economy, which is unlikely to do the banks any good. They look like they've done reasonably well thus far, but that's why I ended by saying the real test will be ahead, because I do think there are going to be a lot of bankruptcies, which have so far been forestalled, but cannot be forever.
So,
if I may add one point, Nicolas, sorry,
Andrea,
because I think it's...
before giving you the floor back, let me add to this a question we have from Noor Aslan Mohammed Medin, which is exactly on this. Are you doing this kind of sector-based analysis? Do you look at, you know, NPLs on the basis of aviation, tourism, hospitality, and the like? And I would also bring in here a question from Francesco Canepa, who is a journalist. Are you preparing a new vulnerability assessment now that we have the second wave and so a different environment in terms of forecasting from the one you had in the first vulnerability assessment that you presented. Sorry for adding up all this. We have many questions.
No, thank you. The first question on sector B, it's clear that, as also Tam said, let's say this crisis is different exactly because it has it has broken the correlations, no, also in terms of sectors. So sectors that are usually non-cyclically correlated have been all hit at the same time, while other sectors that maybe were, you know, typically correlated have moved differently. So this makes our model. We need to be humble again on the ability of our modeling efforts to capture the real path of credit risk going forward. But we are indeed doing ourselves some sectoral analysis, but especially pushing banks to do their own sectoral analysis and to bring to us evidence in terms of how they are going to be affected in terms of, let's say, exposure to sectors that are particularly hit by the crisis. The point I wanted to make quite strongly, which I think is an important one, is that this is not maybe, again, a traditional, you know, cyclical downturn, however harsh. No, it's also a moment in which we might have a structural change in our economy. So if we have a shock that hits especially hard some sectors, and then you have a very massive fiscal response, but however, this fiscal response is focused on some sectors like digital, green, and the like. So we are also going to see a massive shift from in terms of the lending needs of our economies. That's also why, in my view, the proposal on the asset management company is important, because if we get the sector clogged with non-performing loans of the sectors hit by the past, let's say, and the banks are unable to support the sectors which are most, let's say, pushed forward by the fiscal packages. I mean, there could be also some hiccups in terms of the speed and strength of the recovery. So that's another important point. With reference to the second question on preparing another vulnerability analysis, well, we are actually preparing now for the traditional stress test that will start in January next year, and that will run until the late spring, and that will be our next major, let's say, appointment to check the progress or the problems that are there in the banking sector.
I have a bunch of questions about the industry structure, right? Jonas Niemeyer asked about overbanking, and you alluded to that. Miguel Medina asked whether consolidation was something that might exacerbate the too big to fail problem, which is an often heard argument. Andrea Filtri asked about how do you think about cross-border M&A as opposed to just M&A and sector restructuring. Virag Blazek asked about the tools you consider for enhancing bank profitability. Can you give us a bit of, and we also had an anonymous question about whether you specifically encourage exits of banks from the banking market, which of course is advantageous for the banks that remain. So can you give us a sense of, you know, how you think about the restructuring of the banking sector, and specifically what is the ECB's role in there, and what are the tools you can wield to get the sector where you want it to go?
Well, that's an extraordinarily difficult set of questions, but let me put it like that. If you compare let's say the European banking sector and the US banking sector in the exit from the past crisis, I think this is the most striking difference. Tamim was mentioning before the different speed in terms of adjustment in NPLs. We could elaborate on that. It's important indeed, because to some extent we had to develop the regulatory tools to deal with this, so we took a bit longer. But all in all, I think that's not the most important point. The most important point is that in the US, in the first 3 years, there were 500 banks exiting the sector in a smooth way. via, let's say, the FDIC performing purchase and assumption, taking the assets and liabilities of these banks and selling them basically to other banks. Other banks, by the way, in many cases from other states. So not only in the individual state where they were, let's say, falling short in terms of their capabilities to survive. So there was basically elimination of capacity from the sector, no, that was built in the run-up to the crisis. There was consolidation, and the banking sector came back to resilience and profitability, and in a faster and more compressed way. We were not that effective, also because our response was fragmented along national lines. I mean, there was some consolidation within Ireland, within Spain, within each sector that was hit by the crisis, but there was no cross-border deals. There was more generally a lot of support that was deployed towards the banks, but they were just remaining in the market. So they were recapitalized and remained in the market also where they didn't have a sufficiently strong franchise going forward, also in terms of ability to make profits in the longer term. So in my view, let's say, now you have a banking sector which has too many branches, has cost-to-income ratios which are excessively high on average. Of course, let's say I'm talking about averages. There are banks which are profitable, and there are banks which are really in a difficult spot in terms of efficiency. But still, on average, that's the situation. So in my view, some consolidation could help the sector to move forward, especially if it eliminates some excess capacity, focuses the efforts to reduce costs, and focuses the efforts to refocus the business model. In terms of cross-border domestic, let's say, I see that the focus on cost efficiency could make the in-market consolidation a little bit more attractive for the banks at the moment, because that's where you have the most immediate cost efficiency gains. But in perspective, of course, for the sector as a whole, having some cross-border deals would be much beneficial, because it would also have a greater, let's say, diversification of revenues, and would make the system less prone and fragile in front of, let's say, idiosyncratic shocks that could lead to one particular countries. Would this lead to too big to fail? I mean, if you look at the European banks, if you compare the assets to GDP ratio, and you take the GDP of the member states in which the banks are headquartered, I mean, European banks are definitely too big. If you compare them with the yardstick of the banking union in terms of a market, well, they are a little bit less big than they could look like. So the point, in my view, really is which type of yardstick do you use? If you use the yardstick of the fiscal capacity linked to the safety net, they are probably still too big, because EDC, the deposit guarantee scheme at the European level, is not in place. If you take it with reference to the overall size of the customers of the banking market, maybe that might not be such a huge problem. In any case, consolidation does not need to be in the top of the system. Could also be very, especially if you need to eliminate unprofitable franchises, could also be also in the middle and bottom size of the system. So I hope that I covered enough of your questions, Nick.
Yeah, Tam, any brief remark? We have plenty of remaining questions, including some very challenging ones. I'd like to cover as many as possible, but Tam.
Just one of the points that I made, which was that the system is still biased towards large banks, and that does strike me. It is true that these banks are not that large compared to the US if you take the Euro area as a whole or whatever, but it is also true there's a lot of them. And the reason for that is the bias in capital ratios towards preferring large banks.
What do you mean by that, Tam? Can you explain?
Yeah. What happens is small banks have to use the standardized model to calculate their risk-weighted assets. Large banks can use their internal models, and the floor in the US, you're not allowed to have an advantage due to using an internal risk model.
So we're back to the question about ratios, and I have a number of questions here. Caroline Rogers, who is the Secretary General of the Basel Committee now, says, in Europe, there was a rejection of the US proposal of so-called sensible use of the larger of the two measures, right? Internal ratings versus standardized approach. And it sounds a lot like the European resistance to the output floor. Sorry, I'm using jargon, but experts know what I'm talking about. So we also had a question from Jerry Caprio on whether your comment on internal models meant you wanted to completely ditch the risk-weighted capital ratios and only focus on leverage ratio. Can you give us a sense of the balance you want to have, if any, between leverage ratio and risk-weighted, which is also a big theme of Tam's book. And Tam, for a long time, was very skeptical that Europe would adopt the leverage ratio at all. I remember many discussions we had about that. And related to that, even though it's slightly different, inevitably I have questions about dividends. One question from Mathieu Favas, which is the classical argument, is your ban of on dividend or dividend suspension going to put European banks at an international competitive disadvantage, especially compared to their US peers? And an interesting question from Andrea Filtri, who says, don't you have a sense that banks are putting pressure on you to lift the dividend ban by window dressing the third quarter results, by making the situation look very rosy in the third quarter, so that you would allow them to pay dividends again? So I'm not sure you can answer all of these, and I have more questions before we finish. So if you can be very crisp, but lots of policy questions here. You're on mute.
Well, on the output floor and the constraints and the larger of the two between the standardized and the internal models, I think that, let's say again, there is an issue which goes rather deep into the type of questions that we have to put ourselves. So how much we believe that we are in a position via internal models to get a more risk-sensitive ways of targeting banks' capital requirements. To me, the internal models have an important, let's say, benefit that is not always recognized, which is that they are maybe one of the most important entry points for a supervisor in the internal risk management of the banks. So that has given us really additional knowledge on banks which are good in terms of, having data in place, managing, modeling their risks, and being prudent in performing their task in terms of risk management. Now, once you do that, of course, saying, okay, I will allow you to use this sort of framework only insofar as it delivers a capital outcome which is higher than the one that you would obtain without having the internal models at all. Of course, in terms of incentive schemes, is not exactly ideal, I would say. So the point, in my view, is how much you can enable some leeway to the banks to move around the standardized, provided that you are sufficiently satisfied with the robustness of their internal models, which is, however, a very difficult task, as I tried to say before. I don't think that the leverage ratio is an ideal yardstick as well. I mean, the leverage ratio already in the past proved ineffective, because banks have all the incentives to, especially when they start having losses, not to gamble for resurrection, increase their risk taking, because this would not be reflected in the leverage ratio. So eventually they have all incentives to skew their risk taking towards more risky exposure. So that also, from the supervisory perspective, is not so great. So all in all, in my view, having belt and braces, having both of them is the best way forward. And the Basel Committee, with output floor and with the leverage ratio and with some leeway for lower capital requirements if you have good internal models, I think is striking a decent balance. On dividends, I mean, I don't buy this point of competitive disadvantage. I mean, I'm aware that the European banks are suffering somewhat in terms of their valuations. To be honest, their valuations were not so great even before we issued the dividend ban, the dividend recommendation, sorry. It is not a ban, but just a recommendation to banks not to distribute legally. But in terms of ability to attract capital, definitely it is true that there is a sort of difficulty at the moment for the European banks, but I think that this is reflecting well the massive support measures which have been deployed by a number of authorities, by the monetary policy side, by the supervisory side, by governments that are guaranteeing the loan books of the banks. And given the large, let's say, uncertainty which still prevails, I think it has been an important move to make, to wait and pause until we have more visibility. We have closed schools, we have closed factories. I don't see why we shouldn't have paused also in this area. Now, the point is how close we are to the moment in which we can lift this recommendation. The window dressing in the third quarter, I don't think is relevant at all. I mean, we are not looking at that as an important element. For us, what is most important is whether the capital plans of the banks, the capital trajectory of the banks for us is sufficiently reliable or not. And this depends to a large extent also on how reliable or how predictable also is the output and the GDP development, macroeconomic outlook in the going forward.
I would love to have Tam's reactions on this. I would also love to have your answers to other questions. We had a number of questions from Isabella Bufacchi, from Hayakashi Yasu, from Frederick Bistet on the coordination between your shop on supervision and the main tower of the ECB on monetary policy. We had a very interesting question from Bill Cohen on IT investment by banks and how you look at that. All these will be for future conversations because we're past our time already. But I want to thank you both very warmly for what I thought was a very, very detailed, but also very broad conversation about European banking supervision. It's only been 6 years. It's the beginning of a journey. And we're obviously will continue to monitor that and the broader question of banking union and beyond it, European financial sector integration. Thank you very, very much, Andrea, Enria, Tam, Bayoumi, and all of you who participated today. Have a great rest of your day, depending on where in the world you are. And I hope we'll see you again soon. We have the next session in 2 weeks' time. With Huang Yiping and my colleague Martin Chorzempa. We'll talk about big tech in Chinese banking and finance. Of course, that's a work in progress with financial IPO suspension. And so we'll be very much in the news flow as well. Thank you very much again for participating in this session.